Steve here with IBC Global. Today, we're going to go over how a real estate investor is using a whole life insurance policy to improve his overall returns. So what we're going to cover is as follows. The first thing we'll look at is setting up the life insurance policy he's interested in, and we'll focus on what he focused on, which was prioritizing the cash value. He wanted to get as much as possible. Then we'll go over what his specific plan is with regard to funding the policy, and then what I like to call the realities of life. What if he can't fund the dollar amount he thinks he can fund? Then we'll really get into the numbers and look at specifics regarding how he can use the policy to buy an investment property, and we'll look at the returns in the policy and also the returns on his investment property and see if that puts him in a better position. Meaning, does using a life insurance policy actually give you more money than what you would get if you just bought a property? All right, so step one, let's take a look at the policy setup. So with respect to the policy, what he's interested in is starting with a big lump sum. So he's got several investment properties. He is also a doctor, so he earns a good amount of income. So what he's looking at is funding a policy with a large first-year contribution of $500,000. So he's starting with a big lump sum, which will really kick the cash value off to a great start. However, beginning the second year, the most that he'll ever pay into the policy will be up to $250,000. A question I like to ask here whenever we're looking to set up a policy is, in a perfect world, what is the most that you think you'll be able to put into your policy? Not the first year with the lump sum, but as the years pass. For him, if things go really, really well, he thinks he can hit up to $250K per year. Okay, the next thing that we went over with setting up the policy was his minimum commitment. So if we set up a policy where we're showing him putting away $250,000 per year, $250,000, what he does not want, and what most people don't want, is to get a bill for $250,000 every year. So what we like to do here is set the policy up where we are only committed to a minimal amount. You're going to see that his minimum comes out to just about $27,000 per year. So what this allows him to do is have a setup where he is billed for $27,000 per year, and then at his leisure, he can add up to $250K per year. And he's not required to hit that every year either. I'm going to show you exactly what that looks like in a minute. So if we look at his plan, the first year, he is going to start with $500,000. He's got that money in cash already, and he's planning on putting it into the policy. Then he wants to see, what does it look like if I fund $250,000 per year through the 8th year? Why year 8? Is because that takes him up until the age of 60, when he wants to stop funding the policy and then starting to draw income from it. So this shows a best case scenario. However, we talked about what do the numbers look like if you can't max fund it every year. Because when I show you this, it's going to make the illustration look the best it can possibly look, which makes it easier to sell in that respect. So if I'm him, what I would want to see, and I would ask for this, what's it look like if I pay less? So the first year, because he has the cash on hand, we're going to look at that, $500 in the first year. But then what if years 2 through 10, I pay in varying amounts? And I could stop at year 8, but let's assume some years it's only $100K instead of $250K. Show me what that looks like. Then also, show me what it looks like if I only pay the minimum. I'd like to see that before I start the policy. So let's take a look. What we've got to kick things off with is the illustration that he's interested in. A lot going on here. Here's your funding. First year, $500K, followed by $250,000 per year through the 8th year, and then when he's 60, nothing else going into the policy. What we're looking at here is a worst case scenario in terms of what the insurance company is paying him. We're looking at the guaranteed values, which assumes no dividends are ever paid. We're looking at Guardian, who is one of the major mutual companies. They've been in business for over 160 years. They've paid a dividend for over the past 100 years, like they pay dividends. This is extremely unlikely what we've got on the left. But it does give us a worst case scenario. And this is beneficial to look at if you have doubts about whole life insurance and or if you've heard that you can lose money potentially. What I would encourage you to do is to always look at the guaranteed values. If they go up, that's a good thing. If they go down, that's a bad thing. You'll typically see them go up with whole life. It's more so with the universal life products that they go down. Okay, so that's the best case scenario. The realities of life. So what we've got here is varying funding amounts. 500 in the first year, 100 for two, 250 for two, then 100, up and down, but much more conservative overall. So that displays the guarantees, but what we're going to look at when we compare the illustrations side by side are the non-guaranteed values, and what current represents is the current dividend interest rate, which with Guardian for 2025 is 6.10%. All right, let's take a look. We're going to make this simple by looking at everything we just looked at on Excel. So he's 52 years old, in great shape, but we still ran it as the middle of the road in terms of his health rating, just regular preferred. And we're going to start with the best case scenario. So what we've got here, minimum premium, just about $27K, a little bit higher. If he funds a total of $500,000 in the first year, that means everything above the 27.5 is going toward PUAs. Add the minimum up along with the PUA rider, there's your total dollar amount, $500,000. So in blue is what he's paying every year. Make sense? In black tallies up all of the blue payments. So this is nice because it allows you to see what you're paying in and what you have in cash value. First year, you pay in $500,000. Your cash value is $460,000. That's a drawback. The number one drawback to whole life insurance, no matter how well the product is designed, is always the first year, where I take that negative hit. Now, as time passes and he continues to fund the policy, what's highlighted in yellow represents his break-even point, which is the first year his cash value is equal to or greater than what he's paid. And he is so close to year 3, isn't he? He's paid in $1 million. He's got $997 and change. If he gets preferred plus, it'll probably break even year 3. Anyway, there's the plan. The realities of life. All right. So here, if he ends up having to work longer than he currently thinks he'll have to, and he's not able to get $250 in every year, here's what it might look like. This is important to look at, especially if I'm not max funding for the first several years, because I can see, hey, if I don't max fund it in the second and third year, does it impact my break-even point and push that further out? That bothers a lot of people because they want to get past those negative years as quickly as possible. In this case, mainly because of that big old lump sum, he's still cash positive between years 3 and 4. And then lastly, we've got the life happens scenario, which he specifically requested to see, which is showing, hey, what if I pay $500K, but then everything just goes south and I can only pay the minimum premium and I stop after 10 years. Show me what that looks like. All right, we showed him. Check that out. Break-even point, still between years 3 and 4. Fantastic. So we've got a very strong policy. Let's take a look at the cash value growth. This is very, very important to look at. And the way not to look at it is often how insurance companies present it. Where an insurance company, in my opinion that is, what an insurance company might do is if you see $500,000 going in, they'll show the first year cash value growth being whatever the cash value is. meaning $461,000 and change, is what your cash value grew by. I mean, it grew to that amount, but how I would look at this, to be fair, is if I pay 500 grand into a policy and I have 461, that's a loss of $38,000 and change. What about the second year? I'm at 725 and change. What I would do here is take that second year cash value, subtract the first year cash value, and then subtract what I paid in. And the difference gives me my net growth, just about 15 grand. And you can drag that all the way down. So what this is showing us is how much you're getting from the insurance company year over year net. The first thing to look at before you decide to start looking at how you can use a policy from a loan standpoint is making sure that you set it up to have as much cash value as possible. Because if you do that, you'll just have more money to work with. Where buyer's remorse pops up is not when we're looking at loans and we see something we don't like. It's when we find out that we could have had more cash value, but it wasn't set up as in the most optimal manner. All right, let's take a look here. Cool. So, cash value growth. I'm positive beginning year 2 in all of these scenarios, meaning I'm getting back more money than what I'm paying into the policy. That's what I want to see. And then my cumulative break even is what's highlighted in yellow, which again represents when the total cash value exceeds your total payments. So this is the policy he's interested in. All 3 illustrations are the exact same policy. We're just seeing what it looks like if he pays different dollar amounts, different hypothetical illustrations. That's all this is. So here's the question. How can I use this to buy an investment property? So it'll have everything to do with policy loans. When you take a policy loan, what's true is that you are going to pay interest to the insurance company, but you'll also continue to earn dividends on your entire cash value when you borrow against your policy. So what that means is that any cash value you have loaned gets a dividend, and any cash value that you don't have loaned gets a dividend. That is the case with non-direct and direct recognition. If you've done some research, you know what those terms mean. But regardless of the type of policy, you will continue to get dividends on your entire cash value. So here's the question to ask. How do I measure the net returns and see if using this policy to buy this property actually makes my life better? Like, that's what I want to know here. Here's exactly what I would look at. The cash value growth. That's what we just looked at on Excel. That's how much money the insurance company is paying you every single year. Then look at what you're paying them in loan interest, and then add your real estate return. Cash value growth minus loan interest plus return on your real estate gives you the net results. Number 2, if you're financing, then what I would do is subtract loan interest you pay to the bank, which we won't look at that in this example, but that is something that we do for clients because not everyone's in a position where they can dump 500 grand into a policy on day 1. They've got to finance with a bank to partially purchase a property, and then they're also using their policy to finance the property. We want to factor in the loan interest that they're going to pay to a bank. But anyway, let's take a look at the actual numbers here. I'll show you how we break this down for clients and what we did for him. So we're going to look at this illustration when taking loans. All right, so let's go through this one section at a time, shall we? What we'll start with is what we've got on the left, which is just the same illustration we saw. So you've got 500 in the first year, followed by 100 for a couple years, right, through the 10th year, varying amounts. There's the cash value, death benefit, the net annual yield. This is the true growth rate year over year after all of the insurance expenses and everything that comes with the policy. You can also call this your annual ROR, which stands for rate of return. Maximum loan. What this represents is 95% of whatever your cash value is. The most you can typically borrow against a whole life insurance policy is going to be about 95% of whatever you have in cash value. So, maximum loan. Then we've got annual loan. If you want to plug in loans, here's where we plug them in. Loan principal payments, the interest rate, and the loan balance. Pretty self-explanatory. Yearly gain versus yearly interest. This will isolate the net returns in the policy alone when you borrow against your policy. So the yearly cash value is showing you what you are getting from the insurance company net year over year. So look at year 10. What's your growth? $66,000 and change. Keep that in mind. If we go back to the example here, what's your growth in year 10? $66,000 and change. So the cash value growth is showing what the insurance company is paying you year over year. So that's what we get from them. And then the annual interest payment is what we pay them every year. So when we plug in a loan, you're going to see exactly what you're paying them. And then we've got our real estate investment. He's assuming he'll always be able to earn at least 8%. And then we'll see what the cash flow is as well. And then the total return, which will add and subtract everything together. So his plan is to take out $500,000 to buy a property he's interested in. When will he be able to pull out the full $500K all at once? The first year? No. Second year, which would be 6 to 12 months after he starts the policy. Could be 6 months if we're able to backdate it. Anyway, let's look at a $500,000 loan in year 2. Before we take that loan, what are we earning? $15,500. If you take a $500,000 loan, what happens to your maximum loan here? Drops by about $500. What else happens? 500 will result in $25,000 of loan interest that you're paying the insurance company. So I would ask for this, if it's not being shown to you and you have a whole life insurance policy, or if you're looking at one, what is my money growing by? And what am I paying in loan interest? And then what's the spread? I would not look at the dividend rate and compare that with the loan rate. That's not going to give you transparent numbers. What is the net growth in dollars compared to the interest I pay? This will allow you to see if you're positive or negative. He's negative when we isolate the policy in this case. That's typically going to be the case in the early years. But we still want to show it. Like, you can't hide this from someone if you just want to try and sell the long-term benefits. That's how you get people angry at you. All right, so we took that loan, $500K. He used that to do what? Purchase that property he's interested in, $500K. 8% of $500,000 is what? $40,000. 40K in cash flow is what it's producing. Cool. So then what we do here is take that 40 and add it to our spread from the policy. So I lost $9,500, like the net results were a loss, plus the 40 I earned, $30,000 and change. So in the second year, if I take that $500K loan, it hurts me more than it helps me. What do I do in this case? Well, some people look at it and say, hey, I'm okay with the short-term pain because of the long-term gain I get here. how it continues to compound. Some don't like it and say, you know what? I'll drop that loan to $250K because then it only costs me $12,500. I'm still earning $15,500, which means I'm net positive. See what's going on here? But let's go back to 500 because I actually like looking at scenarios that hurt us in the beginning because it shows the drawback in a worst case scenario. So if he takes a 500K loan here, it's cash flowing. Let's assume we take some of that cash flow, let's take the full amount and repay the loan. So under principal payments, you can take the 40K. Look at this. The reality of it is he's going to pay it back faster. Years, he's only funding 100 here. He'll be chipping away at the loans faster. But let's just do 40K per year. So as we chip away at the principal, because these are principal payments in addition to what you're paying in interest, the balance is coming down by 40K per year. Sweet. And as you chip away at that balance, you're going to have less and less in loan interest every year. We'll assume just a flat 8% rate on the real estate. You know that's going to go up over time, but we'll just keep it flat. And here's exactly what people will do. They'll get themselves in a position where the cash value growth is exceeding what they're paying in loan interest. So they've got a positive spread. And then when they add their real estate return to it, it really puts them ahead. And the far right's are total return, just tallying everything up. So we can be creative with this if we want to. For example, someone might be cash flowing their loan at 40K per year and then take additional loans and then start to attack the loan faster. There's all kinds of cool things we can do with these models, but it's all numbers at the end of the day. And all we want to see is when we're leveraging this, like our own bank or our own personal line of credit, is this column in the black, not in the red? And is this column in the black? In the early years, you're always going to be in the red. We've got no loans in the first year, and we're in the red because of the negative hit on the policy. So we do have to be comfortable with that. If we're not, that's okay. I probably wouldn't get a policy if that's the case. But that's exactly how he is using the policy to enhance his overall returns. Last point I want to hit on. This is exactly what we do for clients. What we do from a step-by-step process standpoint is help them choose the right company, help them choose the right product, and then help them use the policy to make more money. That's what we do in a nutshell. Hope you enjoyed this video. Talk to you in the next one.